Thanks for coming, everyone. What's last event is most likely, it would be slightly more geared to grad students talking about as well. So we have Dr. Chris Reeg here. He graduated from the physics department at UF in 2016, the summer of 2016. He worked under Dr. Maslov, and his thesis was superconducting proximity effect in topological materials. He's here with representatives from Boulder Ridge, who graciously hosted and provided this pizza and other goodies, hopefully later. But the whole idea of LAGS is basically giving you an idea of what UF Physics alumni, their career trajectories are after grad school. So he'll be talking about data science at a hedge fund. After, we'll be open to Q&A. But I'll thank the other LAGS coordinator, Dylan, over there standing up. Go ahead, Chris.
Thanks for the introduction, and thanks for the invitation, Davis, for setting everything up. From academia and physics career to data science at hedge fund, but worked my way up from becoming a data scientist to now I'm a strategy manager at Boulder Ridge. All right, so just an outline of my talk. I'm going to start off by just explaining kind of what hedge funds are and how quant funds work. Probably most of you don't know. I'll discuss some typical research problems that we like to think about, just to give you an idea of the types of problems that you might be able to work on if you are a different career path. I also did my best to jot down a list of transferable skills that I think you learn by doing a PhD. They're directly applicable to industry jobs that you don't necessarily learn by not like doing something other than a PhD. And then finally, I'll discuss some opportunities to join our team if anyone here is interested. So first, just very basically, what is a hedge fund? Hedge fund is a company that offers products called funds to potential investors. So these investors can be either internal employees or external investors. There's two types of funds that can be offered. There's proprietary funds, which are open only to internal employees, and there's also external funds that are open to the general public. So these investors give us money. We invest that money however we see fit. Hopefully it looks something like this. I was required to say that it's not guaranteed. You might lose money, but hopefully not. Then if we do make money, that money goes back to the investors, and those investors pay us fees. So typical fees for a hedge fund are 2% management fee and 20% performance fee. So if you just think of a simple example where you're managing $1 billion and you make 20% on that, your management fee will net you $20 million of revenue, and then you earn $200 million for your investors, and they pay you 20% of that. So that's an additional $40 million to give you a total of $60 million in that simple example. So there's opportunity to get a lot of revenue if you can figure out how to invest a lot of money successfully. The previous slide was not specific to hedge funds. It's kind of any investment vehicle looks like that. What is particular to hedge funds are there's two strategies that we have access to that other types of funds do not. The first one is leverage. So what that means is that hedge fund is allowed to invest money that's given to them by investors, as well as money that's borrowed from a third party. So simple example is you get $1 billion of cash from our investors, and then we also go to a bank and borrow an additional $500 million. And that allows us to invest $1.5 billion. And the effect of that is basically to amplify any returns that you generate. So any 1% return that you that your strategy generates will translate into a 1.5% return that your investors see. So it's obviously very helpful if you're making money, and it's also very risky. If you happen to lose money, you can lose it pretty quickly. The second thing that hedge funds can do, which you've probably heard of, is short sell, which is more or less betting on a stock to go down in price. In practice, how this works is you borrow shares from a third party, say a bank, you sell those shares in the market. And then while you hold your position, you're paying interest to the bank on the shares that you borrowed until price goes down enough and you decide to buy those shares back and return them to the bank. So in order to make money on this type of trade, you have to be able to predict the decrease in price greater than the amount of interest that you're paying to borrow those shares, hold that position. The major thing that short selling helps you do is hedge your risk. So you can think of if you have a portfolio of stocks, you have an overall portfolio risk that looks something like this. It's just a linear combination of your positions, WI and WJ. And let's say this is covariance or correlation rho. So most stocks are positively correlated with one another, or positively correlated to the market in general. So the ability to have negative positions allows you to have a lower risk portfolio. If you can get a decent forecast for your covariance matrix. The other thing you can do is allow you to remove your exposure to the stock market as a whole. And what that does is allow you to, in theory, make money whether the stock market is going up or down. Of course, the downside of short selling is that your downside risk is infinite. So if you buy a stock, the most money you can lose is the amount that you invested. If that stock goes to zero in price, in theory, there's no upper bound to how high a stock price can go. So you can short something and lose many multiples of the amount that you invested. So because of the risky nature of these investments, there's a lot of regulations about who is allowed to invest in hedge funds, kind of summarized here. All right, so what is a quant fund? So we're going one level down now. So you can think, roughly speaking, there's two types of hedge funds. There's fundamental hedge funds, which you might think of as someone who does some analysis, then picks stocks that he thinks is going to go up or down, and makes investments accordingly. That's not really what quant funds do. Quant funds are driven by data scientists and researchers, like myself, who develop strategies based on mathematical and machine learning AI models. They're trained on large amounts of data, and everything is kind of done in a systematic way. The researchers at quant funds are often also supported by a team of programmers that implement their code in an efficient way when that code is run in production. So you don't necessarily have to be a great scientist and a great coder. We have kind of a division of labor that's very helpful. We typically trade large quantities in an automated way, which is might not be true of fundamental funds. And then as machine learning and AI has gotten better and better, the share of overall assets invested in quant funds has grown. All right, so what does the typical workflow look like at a quant fund like ours? So the process starts with the data itself, the raw data. So we can purchase data from external vendors, and we can also store proprietary data in our internal database. So these sets of raw data kind of go into a data processing step where they get cleaned up and organized into a final master data set that gets fed to the strategy. The strategy does some fancy things and then spits out a set of orders that it wants to place at that given time. Those orders then sent over to the trading desk, who does some checks to make sure everything is like within the bounds of expectation. If not, they'll flag things for us to look into, and then if everything looks good, those trades will get brought to the market and filled. So you can think of kind of every one of these steps, there's an entire team of people working on. So there's a data team that works on processing raw data. There's a research team that works on developing the strategy itself. And there's a trading team that works on monitoring things and doing like, not just that, but they do a bunch of stuff. And then for a given strategy, it's the strategy manager's job to kind of oversee this entire process from start to finish, and take responsibility over every step of the process. Okay, so that's kind of an overview about how hedge funds work. I have here now a list of like research questions that we like to think about, just to give you a sense of the types of things that you might be able to work on in a job like this. So the first obvious one is, what do we think the price of the stock is going to do? Is it going to go up or down? Over what time frame do we think it's going to go up or down? There's a lot of sub questions to this overall question about price movement. The second one I have listed here is, given a set of predictions, how do we actually figure out what trades we want to make? We have to figure out how far into the future we're going to plan these trades. We have to figure out what we want these trades to optimize for, which is also not a trivial question. So this is also a complicated question that has a lot of kind of sub projects that go into it. What is the correlation matrix between all the instruments in your universe? So I mentioned before, you can short things to hedge risk. That really only works if you have a good estimate of your covariance between stocks.
What's that?
If you
They are
a very bad estimate of the correlation matrix, you can take on way more risk than you think you are. Which is not a good thing. How much liquidity do we expect to be available at any given time? Let's say we have this huge prediction on a given stock that we want to buy a ton of shares in, but no one else is trading that stock. That's going to limit the amount that we can actually buy. So it's just another factor that goes into figuring out what trades we want to make. How do our trades impact the prices in the market? I'm going to leave this one to go into a little more detail on the next few slides, just to give a sense, like a more detailed sense of one of these projects for you guys. And then the last two questions I have here, kind of continuous questions that you always have to think about. First is there any data that you think might be useful that we don't currently have? If that's the case, we have people who will go out and find sources of this data that you're looking for and handle the purchasing, everything like that. But it's our responsibility to figure out what data we want that we don't currently have. And then the last one here is everything behaving as expected in production? So strategy manager's role is kind of split into two. There's the forward-looking research component of the job, where you're always trying to advance the strategy forward. And there's also like the maintenance of what's currently going on in production. So if something pops up or the traders flag something that looks weird, you always have to like dive in and figure out what's going on. And if there's a problem, put out that fire. Usually there's not any issues, but it is a very important part of the job. All right, so I'm going to go into a little more detail about market impact. This might be my personal favorite project to work on. It's like the most directly transferable from physics, I think. So hopefully you guys get a kick out of this. All right, so the idea is if you trade a lot of money, you have large orders that you need to execute over a long period of time. Let's, for example, over an entire trading day. And the reason why this is because it's very costly to fill large orders all instantaneously. So you can kind of see why that's the case if you look at these two charts on the left. These are they're called order books. So on the left here, you have a set of people who are willing to buy a given stock at a given price. So there's 500 people willing to buy the stock at $49.90. On the opposite side, you have a set of people who are willing to sell a stock at a given price. So it's 500 people willing to sell at $50.10. And then the gap in between these two is called the bid-ask spread. This plot on the bottom is just a cumulative sum of the top plot. So let's say I want to place a 4,000 share order. If I want to do that all at one time, you come here and look at 4,000. You would have to pay on average 30 cents per share above market value if you were to do everything at one time. The idea is if you spread out your order and do many smaller fills over a long period of time, you would incur a much less expense than that. But what happens when you fill an order over a long period of time is that let's say you're buying, your buy order puts upward pressure on the price as it executes. So as you continue to fill, you're pushing the price higher and higher, and your subsequent fills are being done at a higher price. And this is a cost to you. This actually represents by far the biggest cost that we have to deal with when trading, and this cost increases as you want to manage more and more money. So if you want to manage more money, you kind of need to have stronger and stronger predictions in order to overcome this market impact cost. And I've also kind of amusingly seen this problem referred to as the Heisenberg uncertainty principle of finance. And this is related to the fact that you cannot simultaneously measure the price change with and without you having placed an order in the market. So the idea is you have this price trajectory along this solid line. At this point, you place an order and you cause the price to increase here. The dashed line is the theoretical price that the stock would be at if you hadn't placed the order. So you have access to one measurable quantity, which is the difference between the initial price when you started your order and any subsequent fills that you have. It's labeled PC, but what you're kind of interested in estimating is this market impacts, the difference between the dashed line and solid line. Of course, like this is not something that's measurable. You can only approximate it the best that you can and account for this when you're deciding which trades you want to make. So because this is the largest cost that most large funds incur, it's a very active area of research across all segments. There's a lot of academic research that you can find on price impact, but the data that academic researchers have access to is very limited. So the models that they come up with are also quite limited. There's a lot of research into market impact at large banks who fill orders for a lot of different clients. They're much better than the academic models, but they're also working with incomplete data. So one example would be if we have a large order that we want to split up and send like half to one bank and half to a second bank. Each bank only has knowledge about the orders that were sent to them instead of the comprehensive picture of everything that they're doing. So obviously the people who are best equipped to estimate our market impact is us, because we're the only ones who actually know what trades we made. at any given time. So we do a lot of research into this project as well. So what we can do is take, let's say, several months of data and look at the change in price as a function of time over the course that which we're trading. And if you average out on the order of like 100,000 or a million trades, you can get a very noisy version of something that looks like this. This is a well-known curve in the literature, but it's verifiable that humanity observes something like this. So what this is saying is that as we start to trade, we push the price up. Then as we continue to trade, the price continues to increase until at this point here at the top, we stop our trade and immediately the price starts moving the opposite direction, reverting back to where it started before we start our orders. So you can kind of tell that this is very disadvantageous for us. As we're buying, we're moving the price against us, so we're causing ourselves to have to pay more and more money to fill this order, and then as soon as we finish, we start losing money on that position. So the goal is to kind of, once we have this this picture of our data, to try to come up with the model to describe it. So one common way to do it, it's found in the literature, is called propagator model. So the idea is to take kind of this very complicated phenomenon of market impact and distill it into something as simple as you can. This is kind of exactly what a theoretical physicist does, if anyone here works on things like that. So I find it pretty interesting. So this is a very simple model. You have your price at time t is given by an initial price plus this impact term plus some noise term. So what this impact term is an instantaneous impact function f, which is some function of your trading speed, and g is sometimes called a decay kernel or a propagator or a Green's function, whichever you want. It takes your instantaneous impact and propagates it forward in time from time t prime to time t. So this is like a cumulative model. And the idea is to come up with some decay kernel and some impact function that can best match your empirical observations of something that looks like this. You also can, well, you should impose constraints on this problem. One constraint is that any round trip trade has to cost money. You shouldn't be able to manipulate prices in order to make money. So this is one thing that we require in our model, because we definitely don't do that. And once you have a model, something you can do is like calculate trading strategy that minimizes impact costs. This is a variational calculus problem, and literally the only time I've ever seen this used outside of like Lagrangian physics. So I had to dig back into my mechanics book and figure out how that stuff worked again when I was looking at this problem, which was fun. All right, so that's kind of it. I just wanted to give you a sense of like an example project that you might be able to work on that you would find interesting coming from a physics background. So now I'm moving on to the section where I tried to list transferable skills that you pick up doing a PhD that are definitely applicable if you want to transition to industry. Well, data science industry, I should say. The first one and most obvious one is mathematical intuition. So most machine learning algorithms are just fancy linear algebra, and most physics is also just fancy linear algebra. So you have a head start in having some intuition about how these algorithms work. There's also occasionally you can use calculus and differential equations, so having knowledge about that is also helpful. Second thing I have listed here is the ability to design research project and problem solving skills. So I would argue maybe the most important thing you learn doing a PhD is actually how to do research. So you figure out what are the relevant questions that you need to ask, how you can address those questions, and what questions you might like to ask you don't think are possible to answer. It's also important to know, so you don't go down rabbit holes that end up nowhere. And it's also useful to have knowledge about how to design controlled experiments or to test theories. So it's kind of very similar to physics, where you have a theorist who comes up with a theory that he wants to test. He'll find an experimentalist who does experiments that are relevant for that theory and kind of work with them to coordinate the control experiment to isolate the phenomenon that they're trying to explain. You can do very similar things just with data related experiments. And it's also cool. You get to be kind of the theorist and the experimentalist in this situation. I call this critical thinking. Another important thing that you learn doing a PhD is knowing how much you can actually conclude from work that you've done based on the assumptions that you made that went into that work. It's good to have skepticism of methods and results. This is true in science as well as anything data related, particularly if you're working in finance and you think you found some huge breakthrough that's going to make you tons of money. It's usually not true. And you have to figure out where things went wrong. This kind of relates to this last point, being able to identify and investigate anomalies and unexpected results. Just as if you're doing an experiment and you see some weird signal that you didn't expect, you have to figure out where that's coming from. Same thing if you find something weird going on in the output of your strategy, you have to figure out exactly where that issue is coming from. Communication skills are very helpful. So as PhD students, hopefully you're giving talks to different audiences. So you might give a talk to your individual group or your subgroup within the department or the department as a whole, or sometimes even you'll give a talk outside the department. It's very similar within the company. You might be communicating with your boss or your team or different levels within the company. And the last point here is continuous learning. It's kind of obvious. Both fields are always evolving, so it's important to stay on top of what's going on so you can remain competitive. I also have two important skills here that, in my opinion, they can be learned on the job. Not everyone shares that opinion, so I want to make that clear. This is just my opinion. The first one is programming. So when I started at Woolridge, I was a pen and paper theoretical physicist who just worked with Mathematica sometimes. But I was able to pick up Python pretty quickly, and everyone was patient enough with me to allow me to develop the skill after I started. So as you gain more experience, you obviously become a better and better programmer, but I'd still say I'm not a great programmer, which is why even after a lot of experience, we have this dedicated team of programmers to translate all of our garbage research code to nice, pretty production code that we brought. The second important thing, of course, is knowledge about the machine learning algorithms that you're going to be using. Before getting a job, for example, you can read up on these algorithms, and there's tons of like YouTube videos that you can watch, trying to explain how these work. These only go so far. I would say they're not that helpful. The most helpful thing you can do if you're interested in a data science career is get your hands on a real life data set and actually try to implement these machine learning models. So one good source of data sets is Kaggle, which is an online platform that hosts data science competitions. They have active competitions as well as their historical ones. So you can just like grab their data set and they have an objective function that they give you to try to optimize, and you can play around with different models on the actual data sets. And you learn way more by doing that than watching YouTube videos. And also a point that I like to stress when you're first starting out, I suggest trying to avoid using prepackaged libraries and instead implement simple versions of these algorithms yourself from scratch. Because when you do that, you get a much deeper understanding about how these things work. It's really invaluable. All right, so the last part of my talk is just a little bit about us. We have our CEO is a data scientist. He is an MIT grad, and this is actually really important from a scientific standpoint, because all the decisions that are being made from the top down are being done with like science in mind. All the decision makers are understanding about scientific process and how like things don't always go very quickly in science. So it's very helpful to have the leader of the company having a scientific background. There's a core research and strategy management group. There's 3 of us. So there's one of us is a Kaggle grandmaster. I have a PhD in theoretical physics, and the other guy has a PhD in math. Then we also have a general research group that's kind of directed by strategy management group. You can see we have a nice mix of different fields and different education levels. But you can also notice we're relatively small, so we're always looking for more people to help out. Since I'm at UF, I also didn't realize this until I was putting this presentation together, but out of, let's say, 10 researchers that we have, 4 of them are alumni of this department. So there's myself. I did my undergrad and PhD here. Kevin Montez did his undergrad, did his thesis with the Marisi group, and then went on to do his PhD at MIT in nuclear physics. Derek Van Gennep did his PhD here at the same time as me, and James Hamlin's group. And then Bill is an undergrad. He's a senior major in physics. He was our intern over the summer and got a job offer, so he's going to start working for us next year. So it's pretty cool that 40% of our research team has come through this department. It's a pretty solid pipeline that we'd like to keep going. If anyone is interested, we always have internships available every summer. We're located in Jupiter. This is a photo of our office complex. So it's pretty cool. The office is right on the water. You can see back here, this is the ocean. It's a few blocks away from the beach. So it's a pretty nice setup. We're currently looking for internships for this coming summer. So if anyone is interested, you can go to this website. This has a list of our open positions. There is positions outside of research as well, if anyone is interested in that. And then anyone who is interested, you can also just email your resume directly to me and I'll pass it along. And with that, I'm happy to take any questions. We also have a bunch of reps from the company around, so I think we'll stick around afterwards for anyone who wants to talk about opportunities further.
Thanks for the talk. Do we have any questions, either in person or on Zoom? You can type it and I'll get to that at some point. Yeah.
Can international students get a job offer from Waterways?
International students, yes. I don't know the details of that. I can talk to Brittany in the back.
Yeah.
Yep.
When you started programming for Woolridge, why did you not transition over to quant development and further quant market research? Why'd you stay as a strategist?
I mean, why didn't I become a programmer? Like
In the quant research,
so it's more like
quant development space.
there's like the programmers are more guys who translate the research work that we do to efficient code. So I was more interested in continuing down the research path. So for that, you need to know how to code. It doesn't necessarily have to be efficient, but just enough to do what you want to do from a research perspective. Does that answer your question?
Yeah.
Kind of.
Yeah.
Okay.
What do you think is like the hardest part to learn when you're transitioning from like into like doing this hedge funds data science from your grad school experiences?
The hardest thing, figuring out how finance actually works, I still don't know. Yeah.
Or relying on interpreters?
We try all sorts of stuff and use whatever works.
So as far as I understand, like markets, they're affected by what you guys do, but also there's real world like events that happen that can influence the markets. Do you guys use those, like you closely monitor what happens in the real world from outside of previous data in your models to sort of help simulate?
You mean historically or real time?
Both, I guess.
Yes, we do. Yeah.
So you have like a team of people monitoring what's happening. Is that what
Our trading team is usually monitoring things that are happening, and then they'll alert us to those things, and then we'll make a decision whether we want to take action or not.
I got one for you.
Yep.
So this may be a bit of a weird question, but now that you've been at Woolridge for a while, do you feel that you're pretty comfortable in your current position in your career, or 5 years down the line, do you see yourself maybe doing something different within the company?
I've kind of advanced almost as far as you can go in the company, so I'd say
Not
happy.
true. You can always become vice president. And
Well, yeah, that job's not available. So I'm not thinking about it.
This is more about like, what you wanted to do. Like when you were going into your postdoc, were you thinking of still of going into industry, or were you still like, do you want to do academia going into your postdoc and then transition during it?
No, I was very much wanting to do an academic career. I started my postdoc even through like a year or two of my postdoc, and then I started to shift my priorities, and kind of led me to change.
So would you say that a postdoc is like not like unnecessary? Like, would you say your postdoc helped a lot, or would you say like if I want to do industry straight out of PhD, I wouldn't need to do a postdoc?
Yeah, I don't think you need to do a postdoc. I mean, postdoc gave me a couple extra years to develop my skills, but it's not necessary.
What do you think is the best way to make industry connections while you're still doing a PhD?
I have no idea.
Okay.
I did not do that, so
you can talk to industry representatives during LAGS events.
yeah. Want to make connections with Woolridge? There's a bunch of us here.
Sorry, okay, I came in a few minutes late. You may have talked about this before. I'm just curious, very specifically, from you, what would you say was either the most interesting and or successful project that you've been a part of, since being at Ridge? Allowed you to talk about that,
The most successful thing,
or most interesting.
What are you most proud of?
Yeah, or like, what was the most interesting thing that like you got to work on?
I got to develop a new strategy from scratch that's been successful so far. So that was definitely the most interesting and successful one.
Since y'all are developing your own strategies, I imagine that there's quite a bit of like confidentiality in your work. Do you like have to work with like NDAs, non-competes, or anything like that?
Yes, we do. We do have non-competes. Yeah. I don't know the details about that, but we do.
Do you recommend us do some sort of internship before we finish our PhD that help us transition to?
Yeah, so the best way to get a job, I think, is to do an internship somewhere and do really well. Because you get like several weeks or several months to work with the people that are potentially hiring you, and you can kind of feel each other out, and if there's a connection, then you'll typically get a job afterwards.
Before working for this specific company, what prior industry experience did you have during your undergrad, doctorate, postdoc?
Nothing.
Wow, okay.
I was like
Interesting.
pure scientific research until 2018.
Did you start out as a data scientist, like a data analyst or data scientist, or was it pretty far advanced?
I started out at the lowest level of the research group that we had at the time.
What does your day-to-day look like at work?
I'd say there's a mix, like it's called 50-50 mix of like doing calculations versus coding stuff. So it's pretty cool. It's actually surprisingly similar to doing physics research.
Or are you still doing like math on pen and paper day to day?
I try to as much as I can, or I can get away with it. I do. Yeah.
Do you use primarily Python or is it mixed?
Yeah, researchers primarily use Python, and then that gets translated to like C++ by the developers.
Would you say your position is like stressful? Like,
Not yet. We start losing a bunch of money, it'll probably get stressful.
When you're transitioning to industry, did you also think of like going to software? Because you can also be a data scientist in software. Why did you choose quant?
Sorry, can you repeat the question?
So, why did you choose like to be in quant instead of like going to software? Because that's what I see a lot of people do.
You mean like Google or something?
Yeah.
I looked at both, but I like the vibes at Boulder Ridge better, so I went with them.
Is there any kind of risk for the data science team? Since so much money is at stake.
Is there a risk?
Yeah.
Yes. It's our job to like, what?
Like for the employee.
Like, will they get
there's
fired if they do bad, or will they be sued for $1 million?
Yeah, like being sued.
Okay.
I don't know about that, but there's definitely risk when you're the one making the decisions. If you lose a lot of money, then you're gonna be at risk, yes. but hopefully not.
I can't imagine anyone suing the actual employees. Because you guys are.
No, you can't sue the employees.
Yeah, exactly.
Are you guys are you guys like a new company? Are you guys founded like in the last years or like 50 or?
Do you know?
15.
15 years? Yeah. I was gonna say 2010, that is 15 years.
Any other questions? I guess, do you think the other reps want to introduce themselves and say what their role is?
My name is Brittany. I'm on the HR team. If you guys are interested in the intern program specifically, you can come talk to us after. We actually have a really great, robust intern program. So we take care of your housing, your transportation. We have a really great program. We do a lot of like continuing education while you're with us too. We do fireside chats, live presentations, lots of cool stuff. So if you're interested, go ahead and apply and then come chat with us after. And we have Tiffany also here from the HR team. Nick from the trading team.
All right.
We have Sarah from the trading team as well. So they can all kind of talk to you a little bit about the technical roles and a little bit more about anything you might be interested in.
Well, let's thank Chris and Ulrich again.